There are a couple of reports that came out this week that tell a fairly intriguing story of the consumer and business spending habits both here and in the US. And they're giving us a mixed picture. In the video today, I want to look at what the new data is telling us. And I want to start right here in Canada. Retail sales are projected to rise by 0.7% in March. And that's a nice rebound from the dip of 0.4% that we saw back in February. And this is according to early estimates. So that's a pretty nice bounce that we're seeing there. But it definitely does come with some caveats. In February, 4 of the 9 retail sectors, they posted declines. They were led by a 2.6% drop there in motor vehicle and parts dealers. And that includes all 4 categories within that sector. So while March's gains are definitely welcome here, they're coming off of a pretty soft base. Some bright spots, food and beverage stores, they jumped 2.8%. Now core retail sales, so this strips out gas stations, auto dealers, it actually grew by 0.5% in February. So the underlying trend looks fairly stable. Now provincially, we see a definitely mixed bag there. Northwest Territories saw the biggest drops in February. Montreal was also hit pretty hard, down 2.5%. Manitoba led the pack, posting a 1.8% increase. Now let's look south of the border. In the US, durable goods, this report shocked everyone. Orders were up by 9.2% in March, totaling $315.7 billion. Analysts were expecting a 2% rise here. So that is a massive difference there. 139% surge in orders for commercial aircraft. And that single category, it pulled the transportation equipment orders up 27% overall. But a key number here, which is non-defense capital spending, that excludes aircraft, a leading indicator of business investment, that just eked out a gain of 0.1%. So it missed forecasts, and that tells us that business spending is still cautious overall. Now here's the question. How much are tariffs helping shape these numbers? Well, in Canada, new or increased tariffs on imported goods, especially autos and electronics, they appear to be putting quite a damper on retail sales in those categories, and that may sort of help explain the slump that we saw in motor vehicle sales. At the same time, though, domestic-focused sectors like food, miscellaneous goods saw strength there, and possibly that reflects a shift in consumer habits due to these higher import costs. Now in the US, that spike of aircraft orders, it could be timing related, but also it might reflect buyers trying to lock in deals ahead of any further trade friction. I think that's probably a big part of that number there. If tariffs are looming or have already taken an effect, some companies might just be front loading orders in order to avoid the price hikes down the road. I think that probably sort of has a big impact on this month's numbers. What does this all mean for us? Well, in Canada here, March retail sales recovery, that looks pretty encouraging at first glance. But again, we're still seeing weakness in some of the big ticket items, and we're seeing that wide regional variation. So I would keep an eye on revisions as they come out in about a month's time there. In the US, that 9.2% jump that we saw in durable goods, that definitely is attention grabbing, but it's largely, like I say, that one-off aircraft number. If we look at broader business investment, that's still soft. Without transportation, the data certainly looks far less impressive. Looking ahead, if tariffs probably continue to weigh on imports, we're going to see more of this split. We're going to see core domestic categories performing better. We're going to see those import-heavy sectors continue to struggle. As for business investment, we can watch how companies respond to trade policies in the coming months, as confusing and difficult and challenging as that may be. If we see a shift in Fed interest rate policies, that could also play a role. Now, I want to shift overseas, and the European Union, they've announced that they have fined Apple and Meta hundreds of millions of euros for violating digital competition rules. Specifically, Apple was hit with a 500 million euro penalty. That's 788 million roughly Canadian. And that fine was for blocking app developers from steering users towards cheaper purchase options outside of its Apple Store. Meta was fined 200 million euros, so that's about 315 million Canadian. And they were fined for forcing Facebook and Instagram users to either accept personalized ads or pay to avoid them. And these are just the latest actions under the EU's new Digital Markets Act, the DMA, which is designed to rein in the powers of the big tech gatekeepers, as they're referred to. The DMA, it's designed to increase consumer control over their data to ensure fairer conversation. In Apple's case here, the EU ruled that the company imposed unfair restrictions that prevented developers from informing users of lower cost purchasing options. Apple has been ordered to remove those restrictions within 60 days, or they will face further penalties. Now, Apple, you might imagine, they strongly disagree with the ruling. They say that they are being unfairly targeted, and the company is claiming that it has made significant efforts to comply with the new rules. For its part, Apple says, despite countless meetings, the commission continues to move the goalposts every step of the way. Now, Meta also did echo similar frustration. They defended its ad-free subscription model, and it claims that the EU's demands are anti-competitive. Meta's Joel Kaplan, he said that the company is being punished for its success and warned of broader economic impacts. He says, "This isn't just about a fine. The commission forcing us to change our business model effectively imposes a multi-billion-dollar tariff on Meta while requiring us to offer an inferior service." Now, EU regulators, they maintain that all companies, regardless of the origin, have to follow the rules in the European market. So these fines, they're not as big as we've seen in the past, but they're clearly an escalation of the enforcement that the EU is putting on of its new digital competition framework. Now, I do want to look at a big fine levied here in Canada against Air Canada, but first I want to have a look at two brand new low volatility ETFs that might help you through the rough times that we're seeing these days. The markets have been all over the map, and that doesn't seem to be letting up anytime soon. So with all this volatility, it's not a big surprise that investors are looking for something a little bit more steady, and that's where a couple of new ETFs from Harvest come in, offering a more stable way forward in the middle of all this market noise. First off, the Harvest Low Volatility Canadian Equity ETF, HVOL is the ticker. It's focused on long-term capital growth with lower overall volatility. That's ideal for balancing out a high-growth exposure. Now, the Harvest Low Volatility Canadian Equity Income ETF, HVOI, this builds on HVOL with an active option strategy to deliver enhanced monthly income. Both of these funds invest in 40 top Canadian equities that are selected using a disciplined risk-based approach. Rules-based portfolio construction limits the exposure to individual stocks and market shocks. Each fund is designed to navigate inflation, uncertainty, and geopolitical risk without giving up on performance protection, and they're both backed by Harvest experienced investment teams. So these lower volatility ETFs are now live. They're built for investors who are looking for confidence in uncertain times. Now, if the market craziness we're seeing these days has you feeling a bit anxious, you can learn more about these brand new ETFs by visiting harvestetfs.com. Now, Air Canada, they have been ordered to pay more than $10 million in damages after a Quebec court found that the airline had violated consumer protection laws. And the case here, which is now 15 years in the making, it involved claims that Air Canada charged passengers more than the advertised fare prices by adding taxes, fees, and surcharges later in the booking process. A consumer group and Montreal resident led this class action suit after they had discovered a $124 discrepancy between the listed price and the actual final charge. Now, Justice Judith Harvey, she wrote that Air Canada acted with ignorance and laxity when it decided it was exempt from the Provincial Consumer Protection Act. The new ruling comes from the Quebec Court of Appeal, and it reserves a lower court's decision, which had acknowledged the legal violation but found no actual harm to the consumers, so it denied any punitive damages. So this reversal here, it's affirming the idea that misleading pricing, even if it's unintentional, still causes real damage to the buyers. At the heart of the lawsuit was the claim that Air Canada's practice of showing only partial fare information during the early stages of the booking, that made it difficult for consumers to sort of make informed decisions, and the court agreed. It concluded that the airline had undermined the transparency and should be held accountable when charging more than what was originally displayed to the customers online. Now, this case, it comes at a time when airlines are facing increased scrutiny over junk fees, extra charges added after the price is advertised. And some airlines are arguing that these fare classes and add-ons, they provide flexibility, but consumer advocates, and I would say as well, these definitely reduce price clarity. Now, Air Canada, they have not yet responded to the ruling as of this morning, but hopefully the decision will send a message to other carriers that misleading pricing structures will not be tolerated under Canadian consumer laws. Now, our last story for today is about Waymo, and this is Alphabet's autonomous vehicle division, and it's definitely scaling up fast. The company is now delivering over 250,000 paid robotaxi rides every week in the US, and that's up from 200,000 just a few months ago back in February. And the growth here, it's come from expanded operations in cities like Austin and the San Francisco Bay Area. It's already running full driverless services in Phoenix, San Francisco, Los Angeles, and Austin. It's also teaming up with Uber now and recently opened rider signups in Atlanta for a planned launch this summer. Now, Waymo is exploring scaling and infrastructure, but it says it hasn't fully locked in a final business model. Now, Tesla, of course, you have to involve them in this conversation. They've been promising that robotaxi fleet for years now, still apparently is quite far behind in the actual deployment of this. Now, Musk told investors the company plans to turn its Model Y SUVs into robotaxis by June this year, but its current system still requires a human driver that is ready to intervene. Now, during during his call this week, his earnings call, Musk did criticize Waymo, and it says its cars are very expensive and low volume. But unlike Waymo, which uses LiDAR sensors, cameras, Tesla relies mostly on a camera-based tech, a method that experts say is more limited. At this point, Waymo definitely continues to lead the U.S. autonomy ride-hailing race, but it is seeing rising competition from other players like Amazon-owned Zoox, Mobileye, and Baidu's Apollo Go. That is a wrap for today's show. As always, thank you for watching. We'll see you in the next video.